most dangerous things about bookkeeping mistakes is that they usually don't look like mistakes. They look normal. The revenue hits the bank, the expenses are categorized, the reports are there, but behind the scenes, things can be missing, duplicated, or posted to the wrong place. And if that's happening, you really can't trust your financials. In this video, I'm going to show you some of the most common bookkeeping mistakes that small business owners make. First, the reconciliation mistakes that make business owners think their books match their bank when transactions are actually missing. Second, how getting paid through things like Venmo or personal accounts can quietly leave revenue completely off your books. And third, the biggest misunderstanding about accounting software, why QuickBooks isn't just categorizing transactions and what's actually happening in the background that can create major reporting problems. A lot of business owners treat accounting software like it's a budgeting app. It's really not. Money comes in, they mark it as income. Money goes out, they categorize it as rent, supplies, or food. It feels simple. But what most don't realize is that every time you record a transaction, two things are actually happening in the background. For example, if you record a meal expense, the software isn't just labeling it. It's creating an accounting entry. Meals expense increases, cash decreases. That's called double entry accounting, and it's the reason your financial reports work. But if you don't understand that system, it becomes very easy to create mistakes that slowly make the financial reports less and less reliable. One of the most common bookkeeping mistakes I see happens during bank reconciliations. A business owner opens the reconciliation screen, they see the difference says zero, they assume everything must be correct. But that's not always what's actually happening. What often occurs is that not every transaction was included in the reconciliation. Some transactions might not have been selected, or they were missed entirely. So technically the numbers balance, but the reconciliation isn't actually complete. And when that happens, it creates a disconnect between the bank and the accounting records. At first, it may not seem like a big problem. The reports still generate, the numbers look reasonable. But over time, those missing transactions can start to create bigger discrepancies. Eventually, the bank balance in the book stops matching the real bank account, and by that point, the mistakes might be months old. And that's where things become difficult, because now you're trying to trace a problem back through hundreds of transactions just to find where things went wrong. The key takeaway here is this: a reconciliation isn't finished just because the screen shows zero. It's finished when every transaction from the bank statement is properly accounted for in the books.